Today we're doing a complete breakdown of ASC 330. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine a retailer overstating inventory by $10 million, inflating profits and misleading investors. ASC 330 addresses this by standardizing how companies value and report inventory. After this section, you'll grasp how this standard ensures accurate financial reporting, protecting stakeholders and maintaining market integrity. ASC 330 emerged to tackle the chaos in inventory reporting. Companies used to have differing methods, skewing financial results. This standard harmonizes inventory valuation, giving investors a true picture of a company's financial health. By requiring consistent practices, ASC 330 ensures that inventory figures are reliable and comparable, reducing misstatements that can mislead stakeholders. Since 1977, ASC 330 has governed inventory accounting. It's obligatory for any entity holding inventory, ensuring consistent valuation practices. The standard's cornerstone is adjusting inventory to the lower of cost or market value, safeguarding against overstated assets. Companies must also consistently apply a cost flow method, ensuring transparency and comparability. This approach prevents financial distortions, protecting stakeholders from inaccurate reports. The cost flow assumption model under ASC 330 is crucial for inventory valuation. It offers methods like FIFO, LIFO, and weighted average, each affecting profit and tax outcomes differently. Understanding these methods is pivotal, as interview questions often probe their impact on financial statements. For instance, in inflationary times, LIFO might lower tax liabilities but reduce reported profits, a strategic choice for many companies. Scope is essential because candidates often assume financial instruments are covered, which is a classic mistake. Knowing what's included or excluded under ASC 330 can make or break your understanding. This differentiates those who truly grasp inventory accounting from those who don't, especially when preparing for interviews. ASC 330 covers tangible assets like merchandise inventory, raw materials, work in progress, and finished goods. For instance, a clothing retailer's shirts ready for sale fall under merchandise inventory. Understanding these categories helps identify how inventory transitions during production, crucial for accurate financial reporting and analysis. Financial instruments, biological assets, and real estate held for investment are common exclusion traps. ASC 330 doesn't cover your stock portfolio or an investor's rental property. Knowing these exclusions ensures accurate categorization, which is vital in avoiding misstatements when reporting inventory in financial statements. Inventory consists of assets a business intends to sell in its normal operations. Think of a toy store's stock of action figures. This definition excludes assets used internally, emphasizing its role in COGS calculation, crucial for understanding a company's profitability and stock management strategies. COGS represents direct costs of producing goods sold, like materials and labor in a bakery's bread production. It excludes indirect costs such as distribution. Accurately calculating COGS is vital since it directly affects gross profit, providing a clearer picture of a company's core profitability. Edge cases can trip up even seasoned accountants. Leased assets aren't inventory, nor are gift cards. Consignment stock may require special attention, but marketing samples are excluded. Understanding these nuances helps ensure financial statements reflect true business operations, avoiding costly reporting errors. Every retailer faces the challenge of valuing inventory accurately. ASC 330's cost flow assumption model helps businesses like Meridian Corporation decide whether to use FIFO, LIFO, or weighted average. This choice directly affects their financial health and decision-making accuracy. Understanding this model is crucial for precisely reporting inventory and cost of goods sold. The cost flow assumption model is pivotal in determining how inventory costs are recorded, impacting financial statements. For Meridian Corporation, handling a $5 million electronics inventory, choosing between FIFO, LIFO, or weighted average can alter reported profits and tax liabilities. This decision affects cash flow management and financial presentations, vital for stakeholders' trust and strategic planning. Determining the precise cost of inventory items is foundational. Meridian Corporation must consider costs beyond just purchase price. Freight, import duties, and handling fees count too. If they ignore these, their $5 million valuation could be misleading. ASC ensures all necessary expenses are accounted for, presenting an accurate financial picture. This comprehensive cost basis sets the stage for proper financial analysis and reporting in subsequent steps. Choosing a cost flow assumption shapes how inventory influences financial results. Meridian Corporation, with its $5 million inventory, must decide between FIFO, LIFO, or weighted average. This choice affects their profits, tax liabilities, and cash flows. Common errors include selecting a method without aligning it to real business operations. ASC demands that the chosen method accurately reflect how inventory is used, ensuring financial transparency and strategic coherence. Implementing the chosen cost flow assumption calculates the cost of goods sold. If Meridian Corporation opts for FIFO, they record costs of earlier stock as sold first, affecting revenue recognition. Missteps here can distort profit and tax obligations, misleading stakeholders. ASC mandates consistent application and clear documentation of method use, ensuring comparability across periods. Thus, accurate COGS calculation influences both financial decisions and investor confidence. Valuing ending inventory is the final step in ensuring accurate financial reporting. For Meridian Corporation, using FIFO means that the latest inventory purchases determine the balance sheet value of unsold stock. Errors here can misstate assets and equity. ASC stipulates that ending inventory must align with the chosen flow method, ensuring that financial statements reflect true business conditions. This valuation is crucial for strategic planning and investor trust. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 330 provides options between cost and market value, but mandates disclosure of the chosen method, inventory classifications, and cost formulas. Let's see how these choices affect financial reporting. Recognizing inventory initially involves capturing all costs needed to bring an item to its current location and condition. This is typically done at acquisition using cost basis, inclusive of freight and handling fees. For example, if you receive goods worth $100,000, freight costs $5,000, the total recognized cost is $105,000. Consistency in recognizing these costs ensures accurate and comparable financial statements. Subsequent measurement of inventory is guided by keeping it at the lower of cost or market. This means if your inventory's market value drops below cost, you write it down to reflect this change. For instance, if a product initially cost $50,000 but now only sells for $40,000, it's written down, impacting income. Regular assessments prevent overstatement of assets, crucial for accurate financials. Inventory shows up as current assets on your balance sheet, categorized into raw materials, WIP, and finished goods. This classification must match how COGS appears on your profit and loss, affecting gross profit margins. For example, misclassifying $200,000 of WIP as finished goods can distort financials. Detailed notes on valuation methods clarify inventory valuations, ensuring stakeholders have a clear view of your company's financial status. Disclosures under ASC 330 are essential for transparency. Inventory valuation methods like FIFO or LIFO must be disclosed, aiding stakeholders in understanding your COGS calculations. For example, switching from FIFO to LIFO can alter reported earnings. Classifying inventory clearly, such as distinguishing raw materials from WIP, helps assess liquidity. Note any impairments or write-downs, as they reveal asset quality and future earnings potential. Imagine a CFO handling a $1 million inventory. Choosing FIFO during inflation could inflate income, while LIFO might minimize taxes. If $200,000 of inventory becomes slow-moving, a write-down affects net income and financial ratios. Disclosing chosen methods and any changes ensures stakeholders understand the financial landscape. Regular impairment reviews keep asset values accurate, providing a genuine snapshot of the company's financial health. Meridian Corporation, a global manufacturing powerhouse, acquires $1,500,000 worth of raw materials for production. Watch how each accounting event unfolds, from recognition to disposal, capturing the full story of inventory under ASC 330. Recording the purchase of raw materials is vital to accurately reflect Meridian Corporation's inventory levels. Under ASC 330, inventory is recognized at cost. This ensures that the balance sheet shows an accurate picture of assets and liabilities, with inventory recorded at $1,500,000 and a matching accounts payable. By applying $600,000 of manufacturing costs to inventory, Meridian Corporation aligns with ASC 330's requirement to include all production costs in inventory valuation. This entry shifts costs from overhead to inventory, reflecting a comprehensive asset account that includes raw material and production costs. Once goods are completed, they shift from raw materials to finished goods inventory. This $2,100,000 transfer is crucial under ASC 330, ensuring the balance sheet accurately distinguishes between inventory types and reflects the true state of ready-for-sale products. Recording both sales revenue and the cost of goods sold is a dual entry crucial under ASC 330. While revenue of $2,500,000 boosts the income statement, the $2,100,000 cost impacts net income, ensuring profitability is accurately reflected. By adjusting for inventory obsolescence, Meridian Corporation adheres to ASC 330's requirement to report inventory at the lower of cost or market. This $50,000 adjustment protects the integrity of financial statements, reflecting a true and fair view of current assets. Settling the accounts payable with a $1,500,000 cash payment reduces liabilities and impacts cash flow statements under ASC 330. This transaction is significant as it closes the loop on the initial material purchase while maintaining supplier relations. Disposing of unsellable inventory and recognizing a $30,000 loss is essential under ASC 330. Accurate inventory valuation is vital for financial statements, ensuring that only sellable goods are recorded, thus reflecting true operational efficiency and inventory management. Every Big Four and investment bank interview on ASC 330 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. ASC 330 is the standard for inventory accounting in the U.S. It ensures consistent reporting of inventory costs and valuation. The purpose is to provide guidance on handling inventories, including how to record and report them. Remember, it deals with cost flow assumptions like FIFO, LIFO, and average cost. Candidates should note its focus on inventory valuation and cost recognition. ASC 330 exists to standardize inventory valuation and ensure accuracy in financial statements. It provides a framework for recognizing and measuring inventory, impacting asset valuation and cost of goods sold. Missteps can distort financial health. Understand its role in safeguarding against inventory misstatements, affecting everything from taxes to investor decisions. Inventory write-downs under ASC 330 are recorded as an expense in the income statement. This reflects the lower of cost or market principle. The write-down reduces inventory value on the balance sheet, affecting profit margins. Always check against market conditions to avoid overstatement or understatement. Remember, frequent write-downs suggest poor inventory management. ASC 330 allows LIFO, while International Financial Reporting Standards prohibits it, impacting cost of goods sold and inventory valuation. International Financial Reporting Standards uses net realizable value, contrasting with ASC's lower of cost or market. These differences affect taxes and profitability. Understand each framework's implications to navigate inventory reporting across jurisdictions effectively. FIFO results in lower cost of goods sold during inflation, boosting profits and taxes, while LIFO increases COGS, lowering net income. This choice impacts inventory valuation, affecting balance sheet and tax liabilities. Avoid the trap of confusing these effects, as accurate choice drives strategic decision-making. Debit, inventory, and credit accounts payable for the purchase cost. This entry increases assets and liabilities. Pay attention to additional costs like freight, which may need capitalization. Misclassification can skew inventory valuation, so ensure entries reflect all cost components accurately. ASC 330 excludes long-term assets like work in process for construction contracts, as they follow specific guidance under other standards. Recognizing exclusions prevents misapplication of inventory principles, ensuring accurate reporting. Misunderstanding scope can lead to compliance issues and financial misstatements. ASC 330 requires disclosure of inventory valuation method, cost flow assumptions, and any write-downs. These disclosures provide transparency, aiding stakeholders in assessing financial health. Failure to disclose can mislead investors and regulators. Ensure clarity in presenting inventory policies and their impact. Inventory valuation affects taxable income. LIFO can defer taxes by increasing COGS, while FIFO might increase current tax liabilities by reducing COGS. Misapplying methods can lead to incorrect tax filings. Always align valuation with business strategy to optimize tax planning and cash flow. Inventory write-downs decrease profits by recognizing an expense that lowers net income. This reflects diminished asset value, impacting financial statements. Misunderstandings arise from ignoring the income statement effect, focusing solely on cash flow. Always account for the immediate profit reduction, not just balance sheet adjustments. ASC 330 sets clear guidelines for inventory treatment, covering all types from raw materials to finished goods. Inventory costs include purchase and conversion expenses. The standard requires valuing inventory at the lower of cost or market, with market value defined by replacement cost limits. Understanding these basics ensures accurate financial reporting and compliance. Understanding the cost flow assumption model is crucial. FIFO, LIFO, and weighted average each impact financial outcomes differently. ASC 330 mandates inventory valuation at the lower of cost or market through the LCM rule, with specific identification for unique items. Inventory write-downs affect net income when market value declines significantly below cost. In interviews, knowing ASC 330's nuances can set you apart. LIFO's allowance in ASC, but prohibition in international financial reporting standards, is a critical difference. Accurate LCM application affects compliance and financials. Disclosing inventory methods, managing inventory turnover, and reconciling physical counts with records are essential practices. Avoid common traps like inventory errors that skew profitability. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.